Welcome to the Big4AccountingFirms.com podcast, brought to you by Big4AccountingFirms.com. This is episode 34. Today we will be talking about some recent controversy impacting the Big Four accounting firm, KPMG. First, I wanted to tell you about two books that we have in the Amazon bookstore. They are the Big Four Accounting Firms Recruiting Guide, which helps you with recruiting with the Big Four firms. And second is our interview book called Big Four Accounting Firms Interview Questions, 32 questions and answers to get you the job you deserve. So check those out on Amazon.com if you need help getting a job at the Big Four. Okay, let's move on to today's topic. We're a couple weeks behind on this topic because I was out of town at a client on the West Coast that hopefully I'll cover on another episode. So make sure to subscribe to this podcast. So what happened at KPMG? KPMG recently fired 6 of their auditors during the week of April 10th, 2017. These firings even included the head of their audit practice in the United States. Now what happened is they were given an improper heads up before an audit by the Public Company Accounting Oversight Board, also known as the PCAOB, and they were given a heads up before PCAOB inspection. So what specifically happened? There's an employee who just joined KPMG from the PCAOB. He received confidential information that one of KPMG's audits would be receiving a review from the PCAOB. He decided to share this information with other fellow employees at KPMG. Now, KPMG found this out from an internal whistleblower within the firm. They said that they learned this in late of February of 2017. Upon learning of this information, KPMG immediately reported this to the SEC and PCAOB. KPMG then launched an investigation, and that investigation was headed by a law firm. Reportedly, these individuals knew of this illegal insider info and failed to report it. Since they failed to report it, that was against KPMG's Code of Ethics, because KPMG's Code of Ethics requires them to report this illegal activity. Since these 6 employees did not report this activity, they were fired. Scott Marcello was one of the people that was fired, and he was the leader of the U.S. audit practice for KPMG. Now, who is taking over? Frank Castle will be taking over for Scott Marcello as a lead audit partner in the United States. His title is vice chair of the audit practice for the firm. He has been with KPMG for 38 years, and he was formerly on the U.S. board of directors for KPMG. He has been on some of KPMG's largest clients, such as General Electric. Another person appointed after this issue is Jackie Daler, who has been named as a partner in charge of audit quality and professional practice for KPMG. So in conclusion, what does this mean? I think it means that the Big Four accounting firms have been having a hard time with ethics. I have heard people speaking about how bad this looks for KPMG, but I think it just looks bad for the industry as a whole, because KPMG did the right thing here after learning what's going on. They identified the bad actors, and some weren't even bad actors. They just didn't report the information. And after identifying these people, they got rid of them, which is the right thing to do, because as a certified public accountant, you are held to a higher standard. You have to maintain ethical standards in order to embolden investor confidence in what auditors do and what certified public accountants do. That's why certified public accountants have to go to school for so long and have to take so many tests, is to prove that they understand what their responsibilities are. The day you pass the CPA doesn't mean you throw away all that knowledge you gained. You have to be able to implement that. And sometimes everything isn't black and white. There are gray areas that you will face in your career. And you have to have the courage to stand up and say, this isn't right, and you have to report it. Otherwise, you can ruin a firm's image. And you can also ruin the image of the CPA. I mean, all you have to do is look in the industry as a whole this year, and it looks terrible if you pay attention. For example, PwC had a whole year of controversy. First, it was a Taylor Bean lawsuit, which was in the billions of dollars, and they ended up settling that for an undisclosed amount. And then they had the huge Oscar screw-up in February of 2017, where they got the most important award, the Best Picture award, and they handed the wrong envelope to the presenter. And lastly, you had the MF Global lawsuit. That was another billion-dollar lawsuit that PwC had to settle for an undisclosed amount. Next up, you had Ernst & Young. Ernst & Young didn't have a good year either. They had trouble staying independent of clients, and they had to pay the SEC for it. They had one partner that used the firm expense account to pay for everything for one of his friends who happened to be a client at the firm and was also an audit client. So this impaired their independence. And they had another partner that was in an intimate relationship with the client, and this impaired their independence there. Thusly, they were fined by the SEC. Ernst & Young was also fined by the SEC for their audit of Weatherford, or lack of audit for the Weatherford. Weatherford had to restate multiple years because of erroneous information with their tax accounting. Ernst & Young was fined by the SEC for that as well. And Deloitte had issues with their audit of Monsanto. Monsanto had to settle with the SEC because of fraudulent accounting that took place over multiple years. And Deloitte was in the news over this for not catching it. The SEC still hasn't done anything to Deloitte, but that's potentially coming down the line. Again, this latest news with KPMG seems less of a reflection on KPMG and more of a reflection on the industry as a whole. It seems that many of these Big Four accountants think that they just have to show up to the job in order to keep it. They don't think they have a responsibility other than that, but that's not right. As you see in this case, you're held to a higher standard. You have more responsibilities. And if you don't fulfill those responsibilities, you can be fired because you can ruin not only a very large firm's image, but the industry's image and the certified public accounting image. So if you want to differentiate yourself from these people, whether you're currently looking for a Big Four job or you're in the Big Four right now, is you need to hold yourself to a higher standard. You need to show people that you're ethical, that you value ethics, and you need to say that, and you need to show it through your actions. If you see something that doesn't seem right and isn't in line with the ethics of your firm or of the public accounting industry, then you need to report it. Otherwise, you do risk your job and other people around you's job as well. That's all we have for today. Thanks for listening. Make sure to subscribe to this podcast, review it when you get a chance, and share it with a friend. Also, make sure to check out our 2 books on Amazon.com. Big Four Accounting Firms Interview Questions, 32 questions and answers to get you the Big Four job you deserve, and the Big Four Accounting Firms Recruiting Guide. Thanks again.